Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Also joining us for the hour is Nate Tuft, Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management. In 30 minutes, we'll set the stage for today's Bank of Canada rate announcement with Jason Daw, head of North American Rates Strategy at RBC. And we want to hear from you this morning on First Call. Reach out to us with your questions on segment trends, and we'll have Nate answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. And if you'd like, of course, you can always email us, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Amazon is cutting about 16,000 jobs as the tech giant continues to streamline operations amid rising AI competition. The American company says it is not their plan to announce broad staff cuts every few months. The eliminations take Amazon's announced job cuts to 30,000 in 3 months after the first wave in October of 14,000. Employees were warned that AI will shrink the workforce as Amazon automates more of its operations. Shares of CGI are up in the pre-market. The Quebec-based company saw a higher first-quarter profit as rising revenue was boosted by demand for artificial intelligence-related work. The IT consulting firm says the quarter shows clients are still spending on modernization and outsourced IT work, including AI projects. On Tuesday, CGI said it is expanding its partnership with OpenAI to meet growing demand. Toronto-based startup Awabi has secured $1 billion in U.S. dollars for funding for commercial expansion. The Uber-backed company develops self-driving technology for trucks and is now expanding to robo-taxis. Awabi received $250 million U.S. in funding from Uber to launch at least 25,000 robo-taxis equipped with its software exclusively on the ride-hailing platform. And, of course, our top-line story now. U.S. President Donald Trump indicating that he is comfortable with the dollar's recent decline, helping send the currency to its lowest level since early 2022. For more on this and the state of global currencies, let's bring in Nate Tuft, Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management. Nate, thanks as always for joining us.
Great to be here.
Dollar dropped yesterday, but now it's bounced back a little. Your thoughts on where it's going in the roller coaster it's on?
Yeah, I mean, the dollar for us is in an early stages of a ongoing depreciation. We went through a period over the last basically decade plus up until last year where we saw dollar appreciation pretty materially across most major currencies. And we think the dollar will continue to depreciate. Now, it won't be a straight line. There'll certainly be some wiggles, but we know there's a number of underlying drivers that are likely to continue to push on the dollar downward. Some of them are the Trump administration wants a weaker dollar. Some of it is that we have a little bit of sentiment against the United States and there are assets moving away from the U.S. based on some of the geopolitical dynamics. And we also have a dynamic where other countries are seeing some relative growth improvements in our view as well. So on the margin, we are in the camp that the dollar continues to be weaker versus most major currency pairs.
So what's the benefit for Trump on this, letting the dollar weaken? Who wins on that?
The primary benefit that he's focused on is it improves the potential for exports. I mean, when the dollar is weaker, it allows other countries to import more of our items at a lower cost. And so I'm based in the U.S., and so I hear that argument. But the flip side of it is most of the world likes to see a stable dollar because we are still viewed as a large power when it comes to currencies and economies globally. So it's a little bit of balancing act. While that's true that the Trump administration is correct that a weaker dollar helps exports, if it gets out of control or gets too carried away, it starts to question the stability of the dollar and the broader stability of the U.S. economy.
And even Trump has said that he doesn't want to see it decline more. He said, I would want it just to seek its own level, but that's fairly an open phrase there. It could mean anything. What would the level it would be? And what level do you think it would be before it becomes problematic?
I think there's a ways to go yet. I mean, if you look at the various metrics, the dollar appreciated a lot over the last 10 plus years. And so on a valuation basis, when you look at like something like a purchasing power parity argument, the dollar is expensive versus almost all major currencies still, with maybe the exception being the Swiss franc. So the dollar is not a cheap currency at this stage. So there is quite a ways to go. The question we want to see, or the answer we want to see, is a very gradual pace of decline. The biggest challenge for currencies is when you see a large move in a very quick period of time. That's what creates uncertainty and more problems for the economy. But a gradual depreciation, even if it's a few percentage points over the course of several years, that's okay. But it's when those bigger moves happen that cause more turmoil.
And what's the concern then for the Canadian dollar if the U.S. continues to weaken today? I notice everybody else has lost a little bit against the U.S. So I've got a frog in my throat there. But the Canadian dollar, we've actually gained a little bit. What's the dangers of us gaining too much against the U.S. dollar?
So we're in the camp that the Canadian dollar can gain against the U.S. dollar. I mean, partly from the valuation arguments. I do think we're seeing some improvement in oil prices over the coming years as well. That tends to help the Canadian dollar. But I also think the economy in Canada is starting to stabilize overall. So we do think there will be some additional appreciation in the CAD. At the same time, relative to other major currencies, the CAD isn't on the top of our list as the strongest currency. We think the euro, the yen, the Aussie dollar, all likely more to outperform versus the U.S. dollar than the Canadian dollar. So generally speaking, we see modest strengthening of the CAD. And if that's the case, I think that's a pretty healthy argument for the Canadian economy overall.
And with the yen, is that the wild card in all this? What concerns do you have with the yen? Or is it?
That's certainly the hot topic these days, given the depreciation that we've seen in the yen over the last several months. And we've also seen recent volatility attached to the potential for intervention. What's even more interesting is whether there's going to be coordinated intervention with the United States as an example. We believe that the yen is very undervalued. So the yen should appreciate over time. But again, it's a question of how quickly do you want to see the yen move. You don't want to see it move too quickly when it comes to depreciation, just as you don't want to see it move too quickly when it comes to appreciation. Our view over the next several years is that the yen probably should be around 140 versus the US dollar, and currently it's well into the 150s. So there's quite a ways in our view for the yen to appreciate in an orderly way for the economy to be fairly stable.
Okay, Nate, we'll wrap it up there for now, but lots more to talk about, including AI coming up next. But we're going to take a look at the markets before the bell. All right, let's see how things are shaping up on the markets. We'll start with the U.S. futures and expecting some key earnings reports today, of course, and also the Fed rate announcement. The markets are showing some optimism as we head into the day. They all hovering near record highs, but you can see the Dow is off ever so slightly, but the Nasdaq up by 0.82% and the S&P 500 by 0.2%. In Asia, the Nikkei's turned things around. It was down quite a bit, but on the plus side for the end of it, but not by much. Look at the Hang Seng up by 2.58%. That's courtesy of some selective risk buying in tech. There, the CSI 300 also up by about a quarter point. Heading to Europe, and we're going to be talking more about this, but Dutch chip equipment maker ASML surging on stronger than expected earnings and upbeat guidance, but the market's not so happy. You can see the FTSE off by 0.5, CAC up by 1.5, and the DAX down by 0.66. And the TSX keeps chugging along. Yeah, another up day yesterday, near record high, just shy of it. Trading was muted, though. I mean, it barely ended up in the green, but it still ended up. Of course, investors are waiting for the Bank of Canada decision this morning. Some of the winners and losers from yesterday. Novagold up by nearly 11.5%. Celestica by more than 7%, going the other way. Constellation Software down by 5.65%. And Cogeco off by nearly 6%. And heading over to the metals, look at that gold surging again. Hit an all-time high at one point of 53.11 during intraday today, but pulled back slightly, barely, though. It's still over 5,300, up more than 3.5%. Silver again surging, up by 6.8% to 113 right now. It's up more than 50% in the last month alone. And copper chugging along at 590, up by 3/4 of a point, we'll say. Heading to oils now, and you can see a big jump for Western Canadian Select. Concerns over winter storm supply disruptions, the geopolitical tensions. It's up nearly 5% yesterday, and let's see what WTI is doing right now. Similar situation. Look, it has jumped up nearly a percentage point up to around 63 a barrel. Well, keep your eye on the technology stocks today. Earnings from 3 of the Magnificent 7 heavyweights coming after the bell: Microsoft, Tesla, and Meta. Meanwhile, technology stocks are driving most of the global indices higher after a sharp increase, although we're seeing in Europe a little bit of a back trend there, but everywhere else. And that's because the orders at ASML added fresh fuel to the artificial intelligence trade. For more on how AI is driving the markets today, let's turn to Nate Tuft, Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management. And Nate, let's talk first about ASML and what you feel that may indicate.
Well, it certainly indicates underlying strength in the AI theme. And I don't think this is a big question. The reality is we know there's massive amounts of CapEx still happening. And the increase in CapEx this year relative to last year is going to be very significant. So the question is, how much is the market priced in for that? The reality is the market has been very excited about AI for a long time. And our view is that not everyone can win in AI. There will be plenty of winners, but there will also be some losers. And I think you're starting to see the market differentiate between the leaders and the laggards here, particularly over the last 12 months. And we expect that to continue to be the case as we look into 2026. And
ASML, just for people might not know the name, it's been around for a long time, and it makes cutting-edge chip-making machines. So they need the machines to make the chips. But the AI companies need, it's like that whole, the hip bone's connected to the knee bone, or I don't know, I can't remember my biology on that. But so it is important. So who is looking like they're pulling ahead at this point to you?
Well, the market's telling the leaders right now are the likes of a Google, the likes of NVIDIA as an example. And then we're also seeing evidence where there's a lot of participation with the other big tens as well. But there are some that have lagged. The Oracles of the world have come back a long ways. Microsoft has taken a little bit of a back seat over the last 6 months. So you're starting to see that greater differentiation. I think it's very important in this earnings season to hear from some of those that have been a little bit behind, such as Microsoft, such as Amazon, and see what their story is around how they're trying to catch up. And that will be a key focal point in the outlook for this earnings season when it comes to a couple of the companies in particular that haven't had the same upside in their stock prices as the leaders have, such as a Google and an NVIDIA over the last 12 months.
And with Microsoft and Amazon, what are some things that might set off alarm bells when they release their earnings? And what are some things that might make you say, okay, they're looking good right now, or maybe they're back on the right track?
The biggest focus for investors, because that's what generates the cash for these companies, is their existing business. So there's going to be a lot of focus on their cloud and how much growth there's been in the cloud space, which is still growing at a very significant pace. But there's also going to be a lot of focus on what does their CapEx cycle look like as it pertains to AI, and then overall how they see the health and how they see the excitement of AI for their businesses. I think the outlook is going to be very important. The numbers are going to be good. Let's be honest. All the big techs in the U.S. are going to report phenomenal earnings. It's a question of whether they're good enough relative to current valuations and whether their outlooks are positive enough to continue to see upside going forward, given how big of a move we've seen over the last several years.
And could we see with Meta and NVIDIA, even though they say their earnings are amazing, still not enough, and it might drive some people away from it?
There's that risk. The reality is these stocks are trading at very significant premiums. Yes, they are supporting that through significant earnings growth, and the expectations of earnings growth is still very high. But any level of disappointment could hit the stocks pretty hard because stocks have been priced for perfection in some cases. And so we are looking for investors are looking for some pretty pristine outlooks and pretty pristine levels of earnings to be able to justify the level of valuation that some of these stocks are. I think we'll get that just based on the underlying trends we're seeing in AI spending, but there are question marks and investors are going to be keenly focused on it.
And what are some sectors that may be related to the Mag 7 and AI that you'll be keeping an eye on as well? And what are some of the indicators there that might set off the alarm bells or go, ooh, okay, we're looking good?
One of the big themes that we see in AI that we think will continue in 2026 is we're seeing a broadening of what it means to benefit from AI. So much of the winners over the last year have been what we call the enablers of AI, the folks that are providing the chips and the infrastructure to set up the overall ecosystem of AI. Where I think we're going to start seeing more of the emphasis is on the beneficiaries of AI. Who's going to be able to control costs, create efficiencies, use AI to drive their business forward and improve their margins. And this is where we're finding opportunities in the healthcare sector, in the financial sector. Sectors that are very data heavy can benefit from faster drug development, can benefit from faster diagnostics, can cut costs because they need fewer people to process data or fraud dynamics within the financial industry, as an example. So we're going to start seeing evidence where the AI benefits are shifting from those enablers to those that are truly going to benefit from the idea that they can improve margins and earnings by incorporating AI in their tool set from a productivity perspective.
Could those companies, you think, eventually overtake the AI companies, the Mag 7, and become the new Mag 7 or the new AI 7 or AI 10 or whatever?
I think there's a potential that you could see a period of time where you have stock outperformance. So if you're referring to the fact that who's going to appreciate the most, I do think some of these names that will benefit by growing their margins by incorporating more tech productivity tools have the potential to outperform the big techs. And part of it is just simply valuations. A lot of the big techs, as we talked about earlier, are priced at very significant premiums. And if there's any evidence that we're starting to see slowdown or even just a modest hiccup in the AI spending, they could be tarnished. While at the same time, the names that are benefiting are trading at much less lower valuations, and they have the potential to catch up a bit in our view. So we like this idea that the market is broadening in the participation, and the beneficiaries are starting to take the lead of sorts when it comes to the potential for returns from a stock perspective.
Okay, we have to take a break now, but Nate, stick around, please. We'll see what's on your radar. Nate Tuft is the Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management. And again, we're going to see what's on his radar after the break. Time to see what's on the radar for Nate Tuft, Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management. And Nate, there is gold in them thar hills. It's up over 4,300, I think, right around the record highs. It's still going, 5,300. That's how much it's been going up. 5,300 record highs right now. And again, another surge today. What's going on? And is there any indications to you that this might slow down? And where are you looking?
It's a fascinating move in the gold and some of the other precious metals overall. I mean, I've been in the industry 25 plus years at this stage, and a chart like this doesn't come across the table very often. And the reality is this is also probably something that we've reset our expectations from a price target perspective more than we've seen anything else over the last decade. And so we keep raising our price targets. When we think about gold, it's a very difficult asset class to value because there's a lot of underlying drivers of. So we tend to use a very simple approach of what are the reds and the greens when it comes to the driving forces behind gold. And there's a lot more greens right now than there are reds. And they include things like geopolitical uncertainty. They include concerns around fiat currency, excessive debt levels, things around debasement, and it comes to overall fiscal spending dynamics globally, dollar depreciation. There's a whole host of things that are flashing green for us that continue to provide support for not only gold, but other precious metals as well.
And what are some of the red lights? Are there any right now, and are you looking for them on the horizon?
The biggest red light is the move that we've seen has been very dramatic. And it's hard to say whether it's overvalued or undervalued. As I said earlier, it's very difficult to put a value on gold or silver. But the reality is the price has moved a long ways. And so we should expect more volatility this year, I think, in the price of gold. And that doesn't necessarily mean the price of gold has to go down, but you're going to see more episodes where you have moves that are 5% up or 5% down in a given day. But as long as those underlying pillars still say green in our view, That is a positive backdrop for gold to continue to push higher. Our current forecast is for it to hit at least 5,500 this year, and there's a very reasonable chance that we'll have to increase those price targets like we did last year. So we are still favorable on both gold and silver as an allocation in portfolios, with an understanding you want to be careful about the volatility and how much you own.
I mean, 5,500 could be Friday.
I know, with these type of moves, that's absolutely the case.
Have you ever seen a curve like, or has there ever been a curve either like this or close to this? And what happened to that curve?
That's the big red question, right? Because when we've seen the levels of gold versus other assets, whether it's looking at stock prices or other real assets, we are trading at extremes. And typically when that happens, you do see a price correction. And so that is the thing that people are watching, is like, what will cause this price action to crack? And so the technicals and sentiment matter a lot when you're looking at currencies, and in particular gold, which does trade on sentimental drivers quite significantly versus other assets. And so there's a lot of folks watching that. But again, if you go back to those pillars that are supporting the price of gold, it's hard to see how they're going to change. We're not going to solve the fiscal spending problems of the world. We're not going to solve the fact that we're printing lots of money anytime soon. So as long as those underlying drivers stay in place, there's quite a bit of support for gold, despite the lofty levels that it's trading at.
And then what? And what about silver too? And in some ways, as much as people are loving it, watching this number go up, it's hard to get in and figure out what to buy, isn't it? For both gold and silver, because silver's just gone insane.
Yeah, I think silver is basically gold on steroids, and there's a couple reasons for that. Silver tends to be a more volatile asset class. Two, there are some more industrial uses of silver in addition to the precious metal aspect of it. And then three, there does historically tend to be more hedge fund and other types of players that traffic in some of these precious metals that are less liquid or not as widely traded. And so you do see some of that type of behavior happening both in silver and gold, which is partially driving some of this move. And so that does create some level of questions about when would those players potentially exit, which could cause some type of drawdown in the price of the metal. And so we're a little bit more skeptical about silver because, one, it's moved further, but two, there's other drivers that are particularly related to industrial uses and supply and demand. But as of right now, the demand for silver remains very high because it does feed into the AI theme as well. So there's a lot of things to like about them, other than the fact that the move has just been so dramatic over the last year.
Okay, we're going to have to wrap it up there for now, but stick around, Nate. We are previewing the Bank of Canada's announcement on interest rates later today, and our phone lines will be opening up soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email, if you'd like it. It's so dry in here. First call at bellmedia.ca. I'm going to have a glass of water. Shares of Starbucks are climbing in the pre-market. The coffee chain topped expectations for global sales, which rose 4% at established locations. Look at that, it's up 7 3/4 right now. The company also issued its first full-year outlook with sales from established locations forecasted to grow at least 3% in 2026. As part of CEO Brian Nichols' turnaround efforts, Starbucks has focused on improving service and reducing menu complexity since 2024. Shares of AT&T are up in the pre-market, nearly 3%. The American company beat estimates for profit and revenue, describing their fourth quarter as the best broadband subscriber growth in a decade. The wireless provider also extended its long-term forecast through 2028, saying it expects to return $45 billion to shareholders through dividends and share repurchases over the next few years. Toronto-based startup Waabi has secured $1 billion in funding for commercial expansion. The Uber-backed company develops self-driving technology for trucks. Waabi received an additional $250 million in funding from Uber to launch at least 25,000 robo-taxis equipped with its software exclusively on the ride-hailing platform. And taking a quick look at the markets, you can see the Dow It's pretty much flat right now, but the NASDAQ reacting to the expectations for earnings from 3 of the Mag 7, and it's up 0.77 right now. The S&P 500 up by 0.18. Well, the Bank of Canada is set to announce an interest rate later today. Several economists are expecting the rate to hold. Let's see what our next guest thinks. Joining me is Jason Daw, head of North American rate strategy at RBC. Jason, thanks very much for joining us. Is this the worst kept secret? And what might surprise everybody? What would it take to surprise us with some kind of either a cut or a hike?
Yeah, it's been our view that the Bank of Canada is going to be on hold at this meeting. It's widely expected from the consensus in markets. The bank is trying to navigate a lot of different cross currents, from trade policy uncertainty to the population growth shock. Going forward, we think most likely they're on hold for the balance of this year. There is some two-way risks, but they seem to be pretty comfortable with where policy is at the moment.
Jason, from my perspective, one area that we've been focused on is, this dynamic of the trade-off between, do they care more about the inflation concerns versus the job market? And, obviously the stability in the job market is certainly questionable. Kind of where do you stand on their preference of focus between those two drivers in the economy?
Yeah, I think what we learned in 2025, at least with the data that we have at hand, is the economy was a lot more resilient than people generally thought. There were pockets of localized weakness. Manufacturing and trade-related employment was soft, but the rest of the economy did okay from an overall growth standpoint and an overall job standpoint. Obviously, the bank is very focused on inflation. That is their mandate, but they are going to take cues from the growth side. And at least up to this point, the economy has looked a lot better than people have feared.
And earlier we were talking about the U.S. dollar and Trump's thoughts on that. Is our dollar and what's unfolding down south of the border, would any of that have any effect on the Bank of Canada and their decision?
People like to speculate that the currency is going to have an impact on monetary policy. We've seen historically that is mostly not the case. You would have to have something pretty extreme happen. And in a scenario, even if the currency got a little bit stronger or a little bit weaker from here, it does not really move the needle for the future outlook for monetary policy.
Another hot topic beyond some of the currency drivers across the globe right now is the idea that we're starting to see questions around independency of central banks, particularly driven by the Fed. Do you think the BOC is focused on that, or they're basically that's someone else's problem? Or how do they think about Fed independency as it pertains to their policy, if at all?
Yeah, it's a good question. I think, the discussions in the U.S. as far as FOMC independence are a little bit overblown, and it seems like, the pendulum is probably going to swing back into the direction that we've normally been accustomed to. For Canada, there is no real direct impact. I think, with at least Carney as the Prime Minister, he respects the central bank. That's been a long-standing tradition in Canada. I don't really see that changing. So any impact on the Canadian side would just really be a residual effect through anything that's happening in the U.S. through monetary policy.
I just want to go back for a second. You mentioned about the population growth. We had a big conversation about that. It seems like it's faded out a little bit. Is that still, or the depopulation? I guess we saw the population shrink. Is that still having an impact? Are the repercussions still being felt from that?
100%. I would say, there is trade policy uncertainty that's happening. That's an important thing for the Canadian economy. But even more importantly is what we're facing from a population growth standpoint. So through the first 3 quarters of 2025, population growth was flat. And that's probably going to be the case for the foreseeable future. And that will, that means we have to recalibrate, what we think is good or bad economic data. It is going to be slower going forward on a trend basis because of population. And unless immigration policy is changed, that is the run rate for the foreseeable future.
Last question from my side, Jason. We obviously, I think you and many others expect a hold for this particular meeting. But what's your outlook for the rest of the year? Do you see additional cuts, or do you think we're pretty much unchanged for the BOC and the status quo for the next 12 months or so?
Yeah, I think as a base case and probably the path of least resistance for the Bank of Canada is to keep policy rates at the current level. They have been characterizing those as appropriate levels, generally kind of in accommodative territory. There is obviously two-way risks. I think for them to cut interest rates, we would need to see the economy be materially weaker than what we've seen up to this point. That's not our base case. That's not the Bank of Canada's base case. And then on the other side of the equation, there is a path to rate hikes. We think that those are most likely to start in 2027, but they could be pulled into 2026 if the economy is growing above trend as we expect as the year progresses.
Okay, Jason, we'll wrap it up there, but thank you very much for joining us.
Thank you.
Jason Daw is head of North America Rate Strategy at RBC. Still ahead, NASA is sending astronauts, including Canadian Jeremy Hansen, back to the lunar neighborhood for the first time in more than 50 years. We'll take a closer look at the mission after the break. And our phone lines are open. Nate Tufte, Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management, is taking your questions on segment trends. Call us at 1-855-326-6266. You can also email us, firstcall@bellmedia.ca. NASA is sending astronauts, including Canadian Jeremy Hansen, back to the lunar neighborhood, so to speak, for the first time in more than 50 years. The Artemis II crew will test a spacecraft that's to play a key role in our return to the moon. Bloomberg takes a closer look.
I think our generation appreciates having a program that now we get a chance to take our own moonshots, what we call great things that humans accomplish.
NASA's Artemis program is the space agency's ambitious mission to send humans back to the moon for the first time in more than half a century.
It has a stark beauty all its own.
The last time NASA sent humans to the moon, they were locked in a space race with the Soviet Union.
Beautiful view.
This time, NASA wants to go back to the moon to stay in order to learn how to live sustainably off of the lunar surface.
I'm Christina Cook, and I'm a mission specialist on Artemis II.
I'm Jeremy Hansen, also a mission specialist. Victor Glover, Artemis II pilot.
Reed Wiseman, crew member on Artemis II.
The Artemis II crew is very much a crew of firsts. It will include the first person of color and the first woman to travel around the moon and into deep space, and it'll also have the first Canadian to do the same.
Just yesterday, our crew did a sim, all four of us, and this is something we'll do over and over again on the way to flight. But there are 1,000 ways this vehicle could kill you in space. And we don't get trained on, every single one of those. We get trained on a methodology to approach the problem.
The moon is a great proving ground for us to operate off of our planet. We've been doing it over 2 decades on the International Space Station. We built a global coalition for low Earth orbit. And now we need to extrapolate that to the moon as we set our sights out on Mars.
4-stage engine start.
Prior to Artemis II, NASA launched the very first major mission in the Artemis program, called Artemis I, which sent the Orion crew capsule around the moon to demonstrate that they could work without a crew on board. Now it's time to show that they can actually keep a crew alive while traveling to deep space.
Our goal is get to the moon and get back. 4 days out, 4 days back.
We are going to do as much science as we can on the way. And on the far side of the moon, we're going to have maybe 45 minutes where we're in a loss of comm with Earth. And all we can do is just train our eyes on that moon surface.
The entire Artemis program has come under significant criticism for how much time it's taking to build and how much money it's costing the taxpayer. There is an estimate that between 2012 and 2025, the Artemis program has cost roughly $93 billion. Despite the criticism, it does benefit from strong congressional support. Many of the programs that are needed for Artemis are spread across the entire United States and provide a lot of jobs for constituents. While the Artemis II mission is coming up, Artemis III, Artemis IV, Artemis V are all a bit of open question marks at the moment. There's development that needs to happen for hardware, notably with the landers that will actually take the humans to the surface of the moon. NASA is pulling out all the stops with its contractors to ensure that a landing occurs no later than 2028, but it remains to be seen if that date will actually be possible. NASA stands at something of a crossroads these days. For much of its history, the agency has been the one to oversee the development and fully fund the development of most of its major hardware. But there's been a big push lately to transfer a lot of that work to the private sector and to the commercial companies that are revolutionizing the space industry. The Artemis II mission comes just as NASA gets a new administrator.
I grew up as the ultimate NASA fan.
Billionaire and fintech entrepreneur Jared Isaacman, who actually has an extensive resume with SpaceX.
America will return to the moon before our great rival, and we will establish an enduring presence to understand and realize the scientific, economic, and national security value on the lunar surface.
Lawmakers and industry officials have warned that if China were to send humans to the moon before NASA returns, the country could stage something of a lunar land grab that would prevent NASA from exploring the lunar surface as fully as possible. There's a lot to be gained for the Artemis program, from learning how to live off-planet and setting the tone for international cooperation in deep space. The goal right now is to land humans by 2028 and to start establishing elements of a lunar base by 2030. But there's still quite a lot of work to do before any of that will be reality.
When are we going to have a sustained presence on the moon? It's a very hard thing to project. But looking at the rapid pace of technology development, leaps right now, I think it's distinctly possible within the next few years. I'll leave it that vague.
Just the fact that that's possible in this time, and that effort grew out of our commercial crew program and sending cargo and then people to the space station on top of Falcons and then Crew Dragons. It's just a great time, a golden age of human space exploration.
So cool. All right, still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including an upgrade on Bank of Montreal. All right, let's take a look at some of the notable analyst calls and recommendations. Bank of Montreal is upgraded to buy from hold at TD Cowen, which highlighted the lender's new timestamp for delivering 15% return on equity. Analyst Mario Mendonca takes a very favorable view on BMO's updated ROE guidance from 15% in the medium term to 15% exiting 2027. He says the ROE guidance seems very ambitious and would require certain conditions, including a strong macro environment that supports all banks, which drives loan growth higher in Canada and the U.S., the continuation of strong trading and investment banking revenues, some growth from these levels, and no dislocation in equity and credit markets. In terms of ROE progression, Mendonca expects BMO to gain ground on peers in 2026 and 27, seeing these gains coming from better than expected earnings power as well as return on capital that is higher than peers. The price target is raised to 209 from 184. Also worth taking a peek at this morning, Seagate. Seagate shares in pre-market trading after its quarterly earnings result and forecast beat the average, is up nearly 10% right now. Seagate price target is raised to 468 from 372 at Morgan Stanley and 500 from 340 at TD Cowen. And Texas Instruments soaring after giving a surprisingly robust forecast for the first quarter, up nearly 7% right now, indicating that demand for industrial equipment and vehicles is recovering from a rough patch. Texas Instruments was raised at Barclays, Susquehanna, the Bank of America, Bernstein, Benchmark, and at Mizuho Securities. Well, they have a jury selection in a landmark U.S. trial involving several social media giants. The platforms are accused of deliberately addicting and harming teens. And France has gone the way of Australia by introducing a law restricting social media access to the young. CTV's Abigail Beeman looks into enforcement and whether Canada will go the same route.
Tara Borvietsky is concerned about how social media has become the social norm, with her oldest of 3 already showing an interest and in the classroom as a high school teacher.
When I see teenagers and students in high school, I just see how normal smartphones and social media are in their lives and how consuming it is for so many of them. And I think that's what makes me nervous about the future for my kids.
She volunteers with Unplugged Canada, a parent-led group encouraging a pledge for no smartphones before 14 and delaying social media use until 16.
Personally try to make a more conscious effort, and I am not perfect, but of keeping our phones out of family spaces.
Borvietsky is encouraged by France's National Assembly vote in favor of a social media ban for children under 15.
We haven't landed on anything yet.
In Canada, the government is planning new online harm legislation after the last bill died with the Trudeau government, but no update on when or whether it will include a ban.
Protect kids, first and foremost. And also there's a legitimate concern of the state protecting freedom of expression, and that is also key. So there's a balancing act.
It can be used as a very vicious tool.
Lawyer Ma'anit Zemel's office gets at least a call a day looking for help. She's calling for nuanced regulations that are enforceable and tailored to specific harms like cyberbullying or overuse, saying a full-out ban is not the answer.
The kids just get around it by using, whether it's VPNs or just saying they're older. And, from a legal perspective here, it might be challenged for all kinds of reasons.
CTV News reached out to YouTube, TikTok, Snapchat, and Meta. By deadline, only Meta responded, saying they'll comply with any regulations. But governments considering bans should be careful not to push teens towards unregulated, less safe sites.
And when we come back, Nate Tuff, Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management, takes your questions on First Call. Time for First Call and first email. We're going to head to the inbox, and the first one for Nate is from Ilya. Good morning. With UNH's results yesterday, I thought would love to hear Nate's thoughts on the healthcare sector. It's taken a bit of a beating, hasn't it?
It certainly is one of the most unloved sectors of the market. It has been for some time. Now, I think the fact that it has been unloved does create some opportunity. The reality is the healthcare sector is the only other sector that can compete with the secular growth that drives technology. And so there's underlying trends within healthcare, particularly demographics, that do drive larger growth potential for healthcare. But the market hasn't appreciated that for quite some time. And a lot of that's been driven by drug pricing concerns, by regulatory concerns, the fall off of COVID type of stimulus and the testing of COVID. There's a whole host of things that have pushed back on healthcare performance. But at this stage, healthcare only makes up like 9% of the S&P when it used to make up like double that. Growth potentials are improving in our view. So selectively, we like healthcare more and more. Now, I think you have to be choosy of where you play. We do prefer the biotechs and some of the drug companies more than, let's say, some of the managed care, which are working through some of the pricing concerns. But given the corrections that we've seen in some of those names, they are getting a bit more appetizing. So growth potential is picking up there, and valuations are pretty attractive.
Okay, let's get a couple more emails in before we run out of time. This one's from Kip. It says, Nate, I'm curious about defense spending in Canada. Can you speak to what's going on in that industry? It's an interesting spot right now. There's a lot of potential.
It is an interesting spot, and we do like the defense companies. The reality is, because of some of the geopolitical dynamics and some of the reordering of the world dynamics, we do believe we're going to continue to see increasing defense spending beyond just the key defense players. We are starting to see more evidence that European countries are spending more on defense for the first time in decades. Asian economies are spending more on defense. So increasingly, as a component of the industrial sector, defense is pretty attractive in our view, in addition to some of the other drivers of industrials, which include the build out of AI as an example, build out of energy infrastructure as well. So there's a lot to like about defense names, including the broader industrial sector as a whole.
And any indicators that you could see the defense industry growing in Canada, more companies coming online?
I don't know about that necessarily. I don't do a lot of company by company work, but the reality is the demand potentially could bring new entrants just given the number of dollars that are at play right now. So it wouldn't surprise me to see some additional contracts going to perhaps smaller players that don't necessarily that dominate in their specific niche, but don't have the same competitive dynamics with some of the bigger players in the defense space.
Okay, we want to get one last one in. This is from Shane, and it's healthcare's other beaten up partner, REITs. He says, I want to invest in more REITs. What should I be looking for?
I think REITs is a bit more of a difficult argument. Don't get me wrong. There's some good quality REITs out there that generate some good, consistent earnings. So if you're going to go into the REIT space, it makes sense to do your due diligence, find the high quality companies that primarily focus on Class A properties, the best of the best, also focus on those that have the least amount of leverage. We think a better option for yield plays is just to own high quality fixed income at this level. Fixed income yields are reasonably attractive in our view. Yields are likely to come down with central banks cutting rates, and the quality is better, and you don't have to worry about leverage and some of the idiosyncrasies of the REITs market. So I think you can get pretty decent yield elsewhere beyond just the REIT sector as a whole.
All right, perfect timing. We're going to wrap it up there, Nate. Thank you as always for joining us. Appreciate it.
Thank you.
Yeah, that was Nate Tuff, Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management. And he's up next with the Open. The market's open in a little more than 30 minutes. Have a great day.